Welcome to the Market Huddle Plus, episode 44. I'm Patrick Ceresna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome back to the show Brent Kochuba, founder of Spot Gamma. Brent, great to have you back on the show, buddy.
It's great to be here. It's been a little while, so nothing like a giant VIX spike, I guess, to finally bring me back.
Absolutely. All right. So listen, I have all sorts of topics I want to hit you up on, but wanted to start the session with a few high-level questions. The options market has been exponentially growing over the past decades, and to a point where options positioning is now directly influencing short-term price movements in the market. And this is your wheelhouse at Spot Gamma. So can you explain at a high level how dealer positioning influences market movements, specifically how actions from all of us market participants in the options market ends up obviously influencing dealer exposure, and then how does dealer exposure impact that market volatility?
Yeah, excellent questions. And as you mentioned, we're really in the forefront here. We just came off this event that was heavily influenced by options activity. And the way that this works is that every time a call or a put is traded, either bought or sold by somebody like me or you or a big hedge fund, there's a liquidity provider on the other side of that trade, right? So there's a bank or a market maker that is buying or selling those options that we are trading. And in fact, the data suggests that 90+% of options are actually traded with a market maker. So what that means, Patrick, is if you're out there buying your Spire calls or whatever it may be, you're probably interacting or buying that from a Citadel or Wolverine or one of those big options market makers. So the options market makers are selling you that call and they need to hedge their position, right? Because obviously if the market goes up, if you're long that call, Patrick, you're making money. That feels great. But Citadel or whomever sold you that call is losing money. And so the way that they would hedge themselves is by buying stock. So they buy a certain number of shares, and if the stock continues to go up, they'll buy a couple more shares of stock, and then on it goes. And that is the transmission mechanism between the call buying or put buying or whatever it may be, and the actual link, right, or the actual flow that moves the underlying price itself. Now, as you had mentioned, the options market has been continuing to grow in leaps and bounds. With the opening of sort of commission-free trading with the likes of Robinhood in 2019 and more recently the zero DTE volume and meme mania. So the amount of options volume, the amount of calls and puts being bought and sold has increased so much that there's a lot of data that suggests, and we believe this, that a lot of the underlying shares that trade, a very significant portion of those underlying shares are hedging flows that we just mentioned. Hedging flows related to dealers and market makers keeping their risk intact, right? So they're buying tons of shares as the market goes up and selling tons of shares as the market goes down. And that has a major impact on markets as a whole.
All right, so let's dive into the current market conditions. And so Friday is the monthly Opex, and more often than not, gamma pinning occurs during these cycles. But based on your analysis, has the market volatility that we've experienced here in the last couple of weeks put the market in a more vulnerable situation? Can you take us through some of your charts?
Yeah, absolutely. And what's so interesting about this, if I could set the scene here a little bit, is into July, we had an incredible number of strange market anomalies. And a lot of people like to talk about this as the correlation trade and short volatility trading in different flows like that. And you can get really into the weeds as far as what that means from the options perspective. But there were just essentially a lot of very crowded trades. Like everyone was chasing semi stocks and NVIDIA, market breadth, right? That the top three stocks, NASDAQ, of the NASDAQ and the S&P, that's NVIDIA, Apple, and Microsoft, are 20 to 25% of the NASDAQ index. So there was this concentration risk. And, selling puts had become a pretty popular strategy as well. And so, we had all these interesting signals that suggested that there's all these imbalances in the market. And a lot of those unwound or started to unwind on Monday. And so if we look back at the way that price action moved into July, what you see is here on this chart is that this is the S&P 500. It rallied very sharply right into the VIX expiration that occurred right before July Opex. So this was right around the 17th. And the interesting thing is that the VIX expiration is on Wednesday and VIX options expire at 9:30 in the morning. And if you go back and look at the charts, you'll find that the high was right at 9:30 in the morning. And as you can see, the market really, as soon as July Opex hit, we just essentially have been falling kind of ever since. And so this is a great example of how these options expirations can be turning points, because as a lot of calls expire in the case of July, the hedging flows associated with those calls also get removed, right? So if
Right.
dealers and market makers had to buy a lot of stock into July Opex as a hedge, suddenly when all these calls expire on July options expiration, they don't need that long stock anymore, right? They could just sell those shares away. And then suddenly, that flow that helps to support the market is no longer there. It's like a leg of the stool gets kicked out, right? Um, so that's a great example of how options expirations can kind of move things. But I wanted to show a few charts, if I could, about the different imbalances, and talk about some of the correlations. So if you remember, Patrick, we had what's called record low correlation, and this chart here shows that. The way that we look at this is that this is the SIBO metric called Core 1M, which is forward-looking correlation. And essentially what it's doing is measuring the implied volatility of single stock options, so NVIDIA, Microsoft, Apple, et cetera, versus spider options or S&P
Right.
options. And when this is making lows, what that's telling us is that the vol of those single stocks is very high relative to the volatility, implied volatility of the index. And what that is from my chair in the options lens is people are buying single stock options and they're selling the S&P options either to fund that or as an arbitrage. And this was driven to an extreme by, as I mentioned before, not only these options trades, but also people chasing performance of the semi stocks, right? It was the AI
Right.
trade that was going to save us. And what's interesting about this is that this correlation metric in particular hit lows that we've never seen before. So it surpassed kind of 2017, which was such an anomalous year. And at the same time, you had, this is breadth. I mentioned before the top three stocks in the S&P and the Nasdaq were over 20% of those indices. And so what would happen is if Nvidia and Apple went up, the S&P would go up, and if Nvidia and Apple went down, the S&P would go down, simply as a function of the math behind how those exchange, those products or indices are calculated. And so the first spasm that we kind of got here in mid July was the Russell trade, right? We got a cool CPI just before July options expiration. And that cool CPI triggered the chase into the small cap. It was supposed to be small cap summer. And we had things like this chart here, which is a little tough to read, but the blue line is showing you IWM call volume. We had the largest call volume ever on a single day for IWM calls, and IWM was ripping right around June 11th and 12th. And those same days that IWM was ripping higher, the NASDAQ and the spiders went lower. So you had inverse correlation between the small caps and the mega caps or the mag sevens, right? It was this spasm of the trade that was working so well, i.e., chasing
Right.
AI stocks and mag seven. Suddenly that started to unwind a little bit, right? As people started to chase IWMs for about a week. And so what that showed is these unusual charts. Like this is from Bespoke, and what it shows is that we had the most overbought reading for any major U.S. index ever with the Russell 2000, right into the middle of July. And I have some correlation charts here that just show. Sorry, where are those? So I got a big deck here. Sorry for making everyone nauseous with my scrolling. This chart here shows the rolling correlation of the 20-day correlation with the Qs. So we have NVIDIA here in blue, but what I really want to show you is the Dow, which is the diamonds, was inversely correlated, as well as the IWMs to SMH, which is the top trade, obviously going into July, as well as the Qs. So the point here is showing that this was an anomalous movement, right? The Dow had never been this uncorrelated, at least in the last 5 years,
Right.
and IWMs are really becoming very uncorrelated. So things were starting to become kind of unglued, is what the point is. And that was not only an explicit options trade, but also momentum chasing, all of these other things. And we can explain this in this other very obvious trade, a chart of, we'd actually debuted this chart in April, and we've seen it show up everywhere else. But this is the number of days without a 2% one-day loss in the S&P. Many of you are probably aware we passed Volmageddon. So the only longer stretch of time without a 2% one-day loss was the great financial crisis. So you've seen this chart a lot, but the other chart you haven't seen is we also went an incredible amount of time without a 2% one-day gain in the S&P. So what that tells you is that volatility in the S&P was anomalous. It was S&P index was not moving at all relative to these single stocks that were whipping all over the place. And this is a lot driven by options volume and the related hedging, but also people just chasing semi stocks, all the names we mentioned before. And then you get these products like the NVIDIA, 3X ETF that just piles onto essentially what is just a momentum trade. Um, and please interject with me. I tend to just start talking once you wind
Well,
me up.
I mean, this all makes sense. Well, first of all, actually, why don't we just talk about the dispersion trade here for a
Yeah.
second? Because obviously, my co-host Kevin keeps blabbing on about the dispersion trade, and that So, question I have for you is: are the risks real, or is it overblown? Like, do you think that this dispersion trade causes some sort of a market dislocation or something that creates some volatility?
I think we saw that on Monday. I think we got a flavor of that, and it wasn't a full unwind. And not everyone got completely blown out of that trade, but I think that it was we've been calling it correlation spasms, meaning with the IWM trade I just sort of explained. When IWM was catching a bid and video was getting crushed, right? And
Right.
so these momentum names tie into this dispersion trade, which I think also relates to zero DT. I think there's a lot of flow that trades short dated NVIDIA or Apple options versus zero DT S&P 500 options. And so as soon as this trade started to break, these HFT shops or other kind of quant shops that are putting this type of trade on, once volatility starts to rear its head, they immediately pull their bids and quotes and that trade goes dead, right?
Right.
Because I think there's a lot of like auto correlation to this idea. Like, hey, there's been a lot of stability in this trade. NVIDIA vol remains high while the S&P vol remains low. And so like today's a great day to continue that trade. And then as soon as like, oh, something weird is happening with the yen or whatever else, and vol's starting to pick up, the VIX is moving up, we just turn that trade off and liquidity kind of evaporates. Another way to frame this trade is on this chart here, which this is actually from the SIBO. And what it shows you is single stock vol was at record high, and this is into July versus the index. So this is a manifestation or a symptom, maybe you want to call it, of this dispersion trade.
Right.
Whether it's the explicit dispersion trade in terms of people buying single stock, options versus selling S&P, or people again chasing momentum stocks in the AI trade and whatever else. And so what happened then, if we go back to this correlation chart here, I want to show the updated version of this. This is what happened over 2 days, right?
Yeah.
Correlation as based on the SIBO metric suddenly jumped higher. We went from two lows never seen before to, middle of the range in terms of the last 5 years of correlation, which exactly corresponds with this VIX spike.
Right.
And if you look at, any period of time where you have a lot of dispersion, meaning certain small sectors are really outperforming other stocks. A great example of high dispersion is the internet bubble, right? In the 2000s, right? Because you had pets.com and all these stocks going just bananas in terms of performance, whereas a lot of other stocks are being left behind. That's a lot of dispersion, which is saying that individual stocks are moving a lot more than other stocks.
Right.
And then correlation tells us that when correlation is low, it tells us that not everything is moving in the same direction. And so when you look at this chart here, we had low correlation because the S&P was going up a little bit, but if you were long the Dow into July, you were only up like 4% on the year, whereas in the NASDAQ, you're up 22% on the year, right? So this is the evidence of the dispersion of performance. Tech was doing great. Dow and IWM into July, not too good. Like you weren't even beating T-bills, right? So, this is what happens in this type of market where you go, hey, this is crazy. Like if I'm long NVIDIA, I'm doing really well. And if I'm a manager and I didn't own enough tech, I'm suddenly down 20% on the year. What other choice do I have than to try to chase tech because I'm not going to get that performance in IWMs, right? So it makes this reflexive behavior of chasing. So the way that correlation unwinds and we get a sync up in all stocks is during a risk off environment. And the way to frame this best is if you look at the 2000 March COVID crash, obviously when the country and world shut down, all stocks went for sale, right? It didn't matter whether you own tech or cruise lines or whatever it was, all stocks got sold and everyone went into cash or to bonds, right? So that's correlation of one because all stocks get sold. And corresponding with that, obviously, is the biggest VIX spike of all time, up in the 80s to 90s in that crash. So in this environment, what happens is we get this extreme positioning Then we get the trigger of the yen trade, which, I don't know that anyone really saw that coming. But once it happened, it triggered all of these flows that had to unwind, right?
Right.
Because vol spiked, correlation suddenly increased, and all of these trades that were working so well for the 6 months to 1 year into this period, those suddenly had to evaporate. And there's a lot of knock-on effects, right? People who are short S&P volatility, like if you're short, as just a basic example, if you're short VIX calls or short S&P puts, well, what are you doing? You're covering those, and there's a lot of evidence that there was margin call type activity on Monday morning. So VIX goes up, people pull these quotes that had. I'll pause right there and say
Yeah.
there's this mirage of liquidity, right? And so there's all these fancy options trades that go on, and on any daily basis, there's a lot of 0DT S&P flow and single stock options flow, and dealers are hedging this flow, and bids and offers seem pretty tight, and liquidity seems fine. And then as soon as there's this risk off event, even just a little trigger, liquidity evaporates, right? These trades that present as offering great liquidity suddenly just disappear, and there's no more liquidity. And
Yeah.
you saw liquidity just break down for a couple of different reasons on Monday morning. But I think that's one real risk. We were given a show of what can happen as a function of this lack of liquidity, as opposed to there being true risk. Like, I don't know enough about the yen carry trade to offer much or really anything. I don't want to offer anything in the yen carry trade.
Right.
I will just simply tell you that these flows had to get unwound. And when they got unwound, liquidity evaporated. And so that made everything move a lot more than it normally would, right? So
Yeah.
you get somebody
Absolutely.
like the gentleman from Wharton saying, we need a 75 basis point rate cut because stuff looks so bad. And it's like, people have to cover this trade. This isn't, the great financial crisis.
So Kevin always had that saying where he says that liquidity is a coward. It's never there when you need it the most. But let's talk about this. You just mentioned Japan, and because obviously, let's go back to Monday. It was August 5th and we
Yeah.
had this event. Obviously, Japan sent shockwaves into North America, causing the VIX to jump to levels we've only seen in previously in market crashes. And I wouldn't call what we saw a market crash. It was a market crash in the Nikkei, which was down 25%,
Yes.
but it wasn't a market crash here. It was just a market correction. But yet the VIX was at levels that would have only seen during major market crashes. And what's your take on Monday in terms of the high tick on the VIX? Like what was it that caused the VIX to spasm to that degree when the price action itself arguably was not stretched to that same magnitude?
Yeah. So I would like to rewind just one day before that, right, to Friday, because I think Friday was a really nasty day. Thursday and Friday of the week before, we were up at 5,500 on Thursday, right before, so it was August 2nd, and we dropped 3% from Thursday into Friday itself, and the VIX hit 20, which was a multi-month high in the VIX index itself. So we went out on Friday with a pretty high vol off of the bad job numbers, right? And then the yen started to move and do some weird things on Friday. We had rates drop sharply. The 10-year had gone from roughly 4 down to about 3.8%. And so there was a lot of rate shifts, I think, that corresponded with this as well, which has exacerbated the situation. And so, what we could see on Friday, and we wrote about this, was that it was a very risky situation on Friday's close, because what had happened is we had moved from what's called a positive gamma market position, and during a positive gamma market position, we have dealers buying the stocks as the market goes down, and then they sell stocks as the market goes up. And so if you're big enough, you're sort of suppressing volatility that way, right? Because you're buying the dip and you're selling the rip and you're keeping things pretty smooth.
The gamma pinning that we talk about, right?
Exactly right. And so when we broke 5,500 on Thursday, we entered into this negative gamma position, which means that as stocks start to go down, as the S&P starts to go down, dealers need to start selling stock and selling futures, and that means volatility is going to pick up. And so that had just broke on Thursday, which helped us really drop into Friday. And then the other impact is you get volatility starting to rise, right? So not only did we have the issue with the yen, we had the jobs number, which put this recessionary kind of impulse in people's minds. And then we had a geopolitical situation, which, a lot of people don't want to say that is a big deal, but, still, that's just this other event that you need to sort of worry about. So when vol starts to rise, implied vol starts to rise, that increases the value, particularly of put options, right? Because we have this what's called skew, which means that put options have a higher implied vol, and that implied vol starts to increase. And that matters because puts get more expensive, they increase in value, which means dealers have to sell more stock and more futures in order to maintain their hedges, right? So
Right.
it's a kind of a double whammy in that situation. So we had really wound this thing up into Friday's close. And then on Sunday night, we all know Nikkei, yen falls apart, Nikkei drops 10%. It's a bad situation, and that creates this margin call type of scenario where the VIX starts to jump.
Right.
Now, in that morning, futures were down a lot, which is going to make the VIX rise quite a bit, the index rise quite a bit, and the VIX is obviously based on the S&P index options prices, specifically 30 days out in time. And the reason I bring that up is because liquidity in the S&P options market, liquidity overall, just generally started to really disappear, as I just mentioned, on Monday morning. And why that matters is because when the bids and offers for S&P options start to widen out, right? If we go from a nice tight market of, let's say, $2 at 250, and suddenly the options market's $1 at $5 or $1 at $10, when that widens out, the value of options, the implied volatility value of options increases a lot. And when the implied vol value goes up, the VIX goes up because the VIX is based on the prices of S&P options. So when the liquidity deteriorates, the VIX jumps.
Right.
And so that is a huge reason that the VIX started to spike on Monday morning. It was a function of the bids and offers and liquidity drying up. Now, some people are saying that, look, the 0DT market broke. That really wouldn't impact the VIX because the VIX is based on 30-day options. But the point is that the index itself is a function of, it's just math based on the prices of S&P options. The other thing that I would note, which is interesting, is there was a big VIX cover trade. And if you go on our Twitter handle, you can see the chart of this. There was a big VIX. It looked like the VIX 30 calls. They were definitely bought. I believe that they were covered in pretty big size. And that corresponds exactly with the VIX high of the day. So I think that the other thing that has exacerbated the VIX move on Monday morning was one person had to cover a big short call trade. And as soon as people started to see that cover, Patrick, the game, right? Like, someone's on the rope. What do you do? Like, wait.
It's like the negative price of oil. It's like ultimately when someone's stuck on the wrong side of a trade, the market gives it to them. It's just the nature of the beast.
Right. And that's the margin call movie or Wall Street from 1987, whatever it is. Like, oh, this guy's on the ropes. I was going to sell you this at $10, but I know you got to buy it. All right, I'm going to sell it to you at 100.
Exactly.
And it was a size trade. You can see it, and it times exactly with that VIX spike at 65. And so I suspect that there was this other issue of the street learned that someone was covering, or maybe it was multiple people. I don't know. It looks like one person, and that widened things out. Because as soon as that trade was done and the market opened, the VIX started to come back down and settled in a little bit. So, you had margin calls, poor liquidity, forced trading, obviously with those margin calls. You had dealer hedging flows, which in some ways are often like a margin call in my view, because if you got to hedge a book, you got to hedge, right? You can't necessarily wait for the perfect price to come around. You oftentimes, I think, have to take liquidity, which can kind of move price. So, that exacerbated all of this volatility. And the other thing that was interesting, if you look pre-market too, NVIDIA, Apple, these stocks were down 10% pre-market, right? As soon as the cash market opened, things settled in a little bit. But there was a real sort of liquidity vacuum that was apparent on Monday morning.
So, so you specifically referenced that the 0DT market temporarily broke. It's basically, it was almost like it shut off. And you have that chart that you can share, but obviously the huge amounts of options volume have moved from weekly and monthly OPEXs to now pushing to 0DT, to the point where 0DT volumes are soaking up a huge percentage of the open interest. Are you worried at all about the 0DT market? Are the fears overblown? I know I had Steve Sosnick on, a former market maker, and he didn't seem to be so worried about it. But like, what's your interpretation of this? Like, how do you size up the way that the options market has evolved up to this point?
Yeah. So as you mentioned, 0DTs, it was 50% of volume, and that's a pretty stable average you could use for the S&P 500. And if you look at single stocks, as far as the next expiration, which is the rolling Friday, you're about 50% in those top stocks, NVIDIA, Apple, et cetera, as well. So it is, zero DTE or next expiration is half the flow into the options
Right.
market. And what I've seen in the S&P specifically is that I think that by and large, zero DT is has a stabilizing effect in the U.S. market. And the reason I'll bring that up is, yes, that zero DT liquidity as the market opened on Monday morning, it seemed to have some problems. In fact, this chart up here shows that the zero DT percentage of volume on Monday was only 25%. This other date was a holiday right around Christmas, obviously. So, that's why that happened. So zero DT evaporated. And on this specific day, I think had a lot to do with brokerages. A lot of them were not functioning. And then there's also this issue of when you need to hedge something, a known unknown, you cannot use zero DT for that, right? If you have
Yeah.
CPI tomorrow, I can buy a zero DT put to hedge that event. But if a bank is going down or the Nikkei is going down or there's going to be a war that I don't know when missiles are start to fly, but I think they're going to fly, I have to buy a longer dated option, right? I need to own Vega. I need to buy VIX futures. I need to buy longer dated puts. I can't hedge a unknown event with zero DTE, right? So anytime you see unknowns come up, like March 23, Silicon Valley Bank goes down, right? Well,
Yeah.
suddenly longer dated options get a bid, VIX calls get a bid, right? That complex catches up. And so you had people more focused on longer dated trading on Monday. And then I think exchanges, not exchanges, but brokers having a hard time opening on Monday morning also hit this. But what we did see when the market started to stabilize was a lot of people were buying zero DT calls on Monday morning. And the reason, and we've seen this before, is if you own a August Opex put or a September put, right, on Monday morning, and you're a hedge fund, you can't sell that put, right, because you need to have that on your hedge as a hedge in your book. But you do want to lock in some of those gains, right? So what do? Well, you could buy a zero DT call. It's essentially hedging your deltas with that zero DT call, such that if the market starts to rip or rally off those lows, well, yes, your put's going to lose money, your September put that you bought, let's say, but that zero DT call is making you a whole bunch of cash, right, to help lock in some of those gains in a way. And so I've seen that that happen time and time again. And so what that does is it brings in a stabilizing effect because I think it helps the market rally back faster when people come in and start buying a bunch of zero DT calls. In a similar fashion, on a day like today with the S&P over 5,400, you see people selling 5,400 or 5,450 calls, and that I think keeps a little bit of a lid on the market and keeps the market from rallying too much. So that stabilizing effect is there,
Right.
and I think by and large helpful. And it also ties back into this liquidity vacuum where we all feel like the markets are pretty stable now, right? We went a record number of days without a 2% sell-off or a 2% rally. Well, suddenly zero DT evaporates, and then we have all this volatility show up, right? Because there's that illusion of stability or illusion of liquidity that zero DT is providing that I don't think is always there.
So Brent, on that topic, like we obviously had low vol, right? Zero, your 2% higher or lower window, and really leading up to this market correction, the short vol trade was in full play. Like basically, the VIX was not only down in the 12 territory, but like right across this entire structure. Like you basically had 6-month, 12-month vol all near record levels. You had 1-day vol near record lows. Like everything was so low. First of all,
Yeah.
who's the primary person that's short all this vol? And in the end, is it like it just seems to set up every time that it's like giving the dry kindling for a market event, yet it seems to be the one thing that everyone keeps piling into in size. Like how do you first of all, who's on that short side, and how does this kind of materialize in your brain in terms of how this short vol trade plays out?
I think that everyone wants to talk about Volmageddon in relation to this correlation trade, and the thing with Volmageddon is there was very clear kind of what the attack vector was, right? There was these ETNs, right? XIV or whatever. I
Yeah.
think it was XIV. I screw up the names, but there was that ETN, right? Everyone was short that in that product, which is this huge, short Vega complex that was destined to blow up, right? And in this case, I'm sure there are short vol funds or funds that run kind of like a net short vol book selling puts. And, one of the funny charts you can see from Nomura was like the beta, the Sharpe ratio of selling like a 5 delta put or whatever it was
Yeah.
like, 5, right? It was like this incredible return from selling puts, because even through 2022 and the big drawdown was like, well, if you just continuously sold puts, like that trade has worked very well. And then you have the situation where I think there's the outright short vol complex, which is people betting on just like VIX futures going down or selling S&P puts. Then there are this correlation trade, which I think is a relative trade, like long single stock vol versus short index vol, and I think that's a pretty sizable trade as well. And so there's these different pockets of this, what shakes out to be a
Yeah.
short volatility trade. And to your point, 1 month realized vol hit 6.5% in early July, which is the lowest it's been since at least 2021. Which again tells us that the market really wasn't moving at all. And in fact, one of the more interesting metrics is that Nomura also put out a chart that the VIX beta on a 1 month basis, the VIX beta to the S&P was 0, which tells us that the VIX was just decoupled from the S&P, which doesn't make a lot of sense when the VIX is based on S&P options prices, right? So, you could see all this manifest as either, an explicit short vol trade with people selling puts, or, again, the knock-on effects of, hey, I'm going to, sell these S&P options versus long index options or long single stock options. And so, when you get this trigger that sends correlation up and makes the VIX rise, right, and people start selling stock, you already had very elevated single stock vol. So that vol doesn't raise much or go up much when the market starts to crash, right? Because Nvidia options are already trading at 60 vol or whatever. But suddenly that S&P vol, which was at like 12, like you mentioned, 1 month forward vol is like a 12. Suddenly that's trading at a 30, right? So that just breaks one side of the trade essentially and forces some adjustment in some covering. And I think because the market rebounded so quickly on Monday, and the Bank of Japan backed off, and whether that helped or not, we never got a war with Iran and Israel, even though they're posturing. Who knows if that still happens? Hopefully it doesn't. That second level or second order kind of follow through didn't come yet, right? And so a lot of people immediately, and it's a reflexive action, like, ooh, VIX is high, I want to short it because vol always mean reverts, right? Or, oh, great, now I can pile back into this trade of long Nvidia and short S&P vol because, it's gotten so high. So people have used this opportunity to kind of start to put trades back on that, they got the wrist slap Monday, but hey, it's worked great for this past week. And so we must be good again in perpetuity.
All right.
Which is kind of funny.
Perfect. Well, Brent, listen, I want to before I let you go, I want to just go back to the great reports you put out at Spot Gamma, and particularly going into this Friday's Opex. Where are the Gamma flip levels? Like, what are the levels that you're watching for the big pivots going into Friday?
Yeah, thanks for that opportunity. So over 5,400, we see dealers have a short, traders are short calls over 5,400. So dealers have what's called a positive gamma position over 5,400 to 5,450. So that's a resistance zone for us into Friday's Opex. And then the big risk off level, the level that you really want to watch is 5,300 to the downside. If we break that, then this negative gamma complex comes kind of roaring back. And I think we really kind of hit like an escape hatch and move down into the 5,200 area pretty quickly due to this negative gamma positioning. So, there's the illusion of stability right now, but, I don't feel terribly confident about, I think this is a very fragile market at the moment. The other thing is that you want to pay attention to, even this options expiration is not massive and it's pretty balanced. So a lot of times we think options expiration has a huge effect. This one, not really. And the reason is too, because we have CPI tomorrow and retail sales on Thursday. So implied vols are really elevated for those two data points, as well as Jackson Hole on the 24th, which is next Saturday, I believe. Yeah. So we can't get a full reversion in implied vol, which we really need for full stability until these data points pass. And the thing that I just wanted to bring up, and I know we got to wrap this up, is we had this correlation trade, right? Everyone was long Nvidia, and it was sort of like, what stock do I own? Do I get into semis or am I getting into small caps? Like, I need to own equities. Which ones do I own? And I think that trade is kind of ending. And the reason I think that is happening is because we are pricing in 100% chance of a rate cut in September. Now we're arguing whether we're going to get 25 bips or 50 bips
Yeah.
because either we have a recession or we don't, right? So we're going to get a rate cut, it seems. And what was so funny about this crash is that the 60/40 portfolio performed very well over this recent,
Yeah.
spasm, right? Long bonds, if you look at TLT, was up 4% over the same period that S&P went down 4%. And so what I think is going to happen is people are going to be worried more about allocating from equities into credit or bonds, right? Especially if rates are going to change a bunch, as opposed to necessarily worrying about, hey, like which stock do I have to own? Like it's going to
Yeah.
turn to, hey, do I own stocks or do I own bonds? And so that's the shift that I see really happening here. And I think if people suddenly want to own bonds because things aren't looking good, that probably means that equities, have a little bit of a rough patch.
There you go. Brent, where can listeners find you and learn more about your services?
Thank you so much. Spotgamma.com. Actually, if you go to spotgamma.com/opex, OPEX, we have a OPEX spreadsheet you can download with some additional content tied to that. And then I'm at SpotGamma on Twitter as well.
Oh, fantastic. Well, thanks, Brent. So glad to have you back on the show, and we'll have to do this more often, bud.
I love to. Thank you so much for the opportunity.
All right. Well, thanks for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.